It's the beginning of a new month, and that means it is time for your piping hot monthly Bitcoin digest. Today, we're going to talk about Bitcoin supply and demand dynamics, as well as the latest and greatest in Bitcoin tech. Let's jump in. So starting with our first topic, it's probably been a couple months since we delved into the supply and demand dynamics of Bitcoin, and I always think it's very interesting. I don't necessarily think it's going to change decisions for sat stackers and hodlers, of which I am one, but I do think it's important to realize what is going on and why, especially since there's some very, very interesting things happening in the economy right now. So first, let's start with the supply side of things. This is pretty clear and easy. Number one, we've just seen the all-time high for the percentage of Bitcoin supply that is with long-time hodlers. And so as we can see, we are at the highest level ever at just over 76%. And secondly, and I showed this a couple months ago, the supply on Bitcoin exchanges continues to go down. In fact, you had $220 million worth of Bitcoin fly off exchanges just in the last day of September, which is very interesting. And so this view is from January 2018 to about midway through 2023. But for even additional historical perspective, we can look at Coinbase just as an example, which goes even further back this particular chart. And you can see just how wild this is, right? From 2014 all the way through 2020, it was pretty much a one-way train up. And then something fundamental happened and changed in 2020. And we have seen that trend reverse. And my interpretation of this is you now have this transition from people saying, oh, you know, this is a fun way to trade and make some fiat gains, to many more people coming to the realization of just how profound and important Bitcoin is, right? Oh, this is the exit strategy, putting my life savings into an unconfiscatable, censorship-resistant, scarce asset. And so again, as I've said on this channel, for all the people that are like, well, Bitcoin can't survive in a high interest rate environment, number one, it's doing pretty darn well. And we'll talk more about that in a moment. But two, just as critics say that's so unprecedented, Bitcoin's never, seen this. Well, we've never seen this supply dynamic either. And then lastly, of course, the halving is imminent, slated for roughly April of next year. So the daily new issuance of Bitcoin will be cut in half, which sets in motion this intricate dance of market participants that tends to lead to Bitcoin price appreciation in the ensuing months, typically 6 or so months, kind of lagged to that halving event. So the supply side should be pretty obvious for anyone with a brain to see that that is extremely attractive. But now let's go to the demand side, because this is where things get really interesting. And as part of this, I want to delve into the macroeconomy and what is happening, because I think it is profoundly fascinating. And regardless of how interested you are in sort of macro stuff, I just think it's really, really interesting, in particular, what is happening right now. And so on the demand side, the main bearish argument typically is some variant of like, well, again, as I was just saying, Bitcoin can't survive a high interest rate environment. And to the Fed's credit, I think they have gone further than a lot of people, myself included, would have expected, right? You even had all the banking system issues earlier this year in the US. I think a lot of people looked at that and said, okay, it's over, the Fed's gonna pivot, and yet they didn't. They pivoted in the sense of the bank term funding program, which basically is a bailout. Like, they bailed these banks out. They bailed the whole banking system out, to be very clear. They basically said, hey, your underwater bond, you can give it to me and I'll honor the 100 par value. That's a bailout, make no mistake. So they did pivot in a sense in terms of providing this liquidity backstop in this fashion. But, they have continued their rate hiking. Now, they did pause in September, but, they're posturing and gesticulating around higher for longer, higher for longer, higher for longer. And so let's examine that as our main scenario for today. Higher for longer is indeed what we see. I think many of us could probably agree that, well, if they pivoted arbitrarily today for no reason, rates are going to come down. They start expanding their balance sheet once more, some various flavor of quantitative easing. We don't call it quantitative easing. like that's probably going to be very good for Bitcoin. So let's set that scenario to the side and take the higher for longer scenario as a credible reality of what we do see. So the first possibility is we careen right into a recession or economic crash, as many have been predicting for some time now, right? We do see inflation, quote unquote, coming down, even though mainstream economists like Paul Krugman keep taking out the components that actually are increasing in price. But suffice to say, let's just grant that we are seeing disinflation. Prices are still increasing, but they're increasing at slower rates than they were previously. And we can look and also see that the M2 money supply is contracting at the fastest rate since the Great Depression. So like there is something real there, right? Yes, the government's inflation statistics are scams, but there is something real happening with liquidity. And you can see that, right? There's different pockets of real estate. Consumers are tightening their belts. And so a lot of people are like, where is the recession? Like I can see all these signs of it. But keep in mind that individuals, households, as well as companies did use the very low near zero rates as an opportunity to load up on debt. And so I think that's what's helped people coast through this kind of slowing economic times that we find ourselves in. And keep in mind as well that something like unemployment is typically quite lagged to the actual interest rate increases. Someone like Jeff Snyder does a very good job of painting all the kind of economic weakness happening, not just in the US, but globally. He does a lot on China and Asia. And so it's clear that the market is anticipating a major slowdown in the economy. When it happens, who knows? But let's say that it happens quite imminently, maybe in the next 3 to 6 months. With debt levels this high, that would be very, very bad. We would see a massive giga-sized crash. And so while yes, that could present the opportunity to stack some more sats even more cheaply than we're doing now, number one, I'm not really holding my breath for that because of what we'll discuss next. But then two, this kicks off the next cycle, right? Big crash, yes, it might be really bad, but the Fed will intervene as it has every single time. Going into an election year, it will be no different. If a recession truly actually does happen, again, you could argue that pockets of the economy are already there. But if it truly happens and you have actual unemployment, make no mistake, the Fed will pivot and this will kick off a new interest rate and liquidity cycle, after which Bitcoin will do quite well. So that's one scenario. But let's talk about the most interesting scenario of them all, which is that we never get there, which is that this recession that people have been predicting is coming, it's coming. It never comes. And indeed, this is increasingly looking like the situation that we are in. The Atlanta Fed publishes their GDP Now estimate. And again, we know that GDP numbers are fudged just as the inflation numbers. But the fact is that every investor on planet Earth pays attention to this and puts at least some credence into it. And I do think directionally it is an important indicator. And so they're estimating real GDP growth for real, again, not nominal, real GDP growth for Q3 is at a staggering 5.7%. As a quick note, as you can see, that has actually been revised down quite a bit to what is now 4.9% as of the making of this video. There's another update coming out probably when this video is coming out. But in any case, that is still massive. Which, side note, keep in mind that what that means is that nominal GDP growth is more like 7, 8, 9%. So actually, the people who are saying, oh, look, I could get this great, 5%, whatever yield on my government bond, you're actually making a negative real yield if you consider the overall growth of the economy versus something like the manipulated inflation statistic. Arthur Hayes' latest Substack goes into a really nice analysis of this that I would encourage you to check out. So again, keep that in mind. Like even with rates elevated, bond investors are still getting a negative real yield if we use reasonable metrics for that calculation. But stranger still is that amidst this arguably gangbusters growth, government deficit spending is exploding. And this is very, very different and in many ways unprecedented to what we typically see in economic cycles. If the economy is growing, that means you have more economic activity. That means there's more tax receipts. That means, the government is taking in more money. That tends to lead to at least a scenario in which deficits aren't absolutely exploding. And yet that is exactly what they are doing currently, to the point where even a mainstream government mouthpiece like the Washington Post, you've got these guys saying like, we literally don't know what's happening. Like they are literally admitting, these are mainstream economists admitting that they are confused and have no idea what's going on. And so what is going on? Well, something called fiscal dominance. People like Luke Grahman and others are talking more and more about this. If you're not following Luke's work, I don't know what you're doing. And so fiscal dominance means the following. While the rate hikes have in many ways reduced overall economic demand and arguably at least have led to some lower inflation numbers, at least in parts of the economy. However, keep in mind the different components of GDP. Of course, one of those is government spending. And government spending is absolutely exploding. In a single day, as we can see, the US government added $275 billion to the national debt. Now, a good portion of that was Social Security payments, with the timing here being right at the end of the quarter. But still, keep in mind we've added nearly $500 billion in the last 2 weeks. So that's a monthly pace of nearly $1 trillion. And that was after adding $1 trillion over 3 months previously. Guys, these numbers are like mind melting. We casually throw trillions around now, but this is totally so astronomically insane. Don't let any mainstream normie or government mouthpiece or economist try and gaslight you into thinking that, oh, everything's fine. That is crazy. And indeed, we can see that government spending as a percentage of GDP. So this is a critical view, right? Even this is increasing and it's at wartime levels. So what is happening? Because interest rates are now so high and the pile of debt is growing ever larger, the US government's interest payments that it has to spend are increasing exponentially. And this is adding to GDP growth. Now, where is all this interest income going? The government's spending all this money, sending interest payments to all the holders of US government debt. Well, obviously, there's a lot of big institutions like pensions and insurance funds and sovereign wealth funds, but there's also households, right? There's also, the couple of boomers that's getting ready to cash out their retirement plan, and they're receiving higher interest income than they have in decades. What are they doing with that money? They're going out and spending it. They're going on trips. They're going to restaurants. So this is why you've seen the services sector in particular remain fairly resilient, certainly relative to the more kind of manufacturing sector. So here we can see the problem. Fiscal dominance, or the US government having to spend more and more and more and more money, starts to counteract the very goal of raising rates in the first place, which was to stymie and slow down economic activity. And oh, by the way, the US government is estimated to need to issue a net new $2 trillion in debt next year. And we can see that that is probably an underestimate if the current trend is any guide. Furthermore, they have to roll over $5 trillion of their existing debt. What that means is that they are literally taking out new debt, new $5 trillion in debt, to pay the old debt back, but this time they have to take it out at a much, much, much higher interest rate. And by the way, that is literally how this works. The government takes out debt to pay the old debt back, okay? So anyone holding bonds, like, that's how this works, only getting paid back in inflated dollars. And so this dynamic is going to continue with all this new debt and rolled debt that needs to happen. And it would be bad enough if they had to do that at the current rates, but yields continue to rise, right? As we can see in this post from Charlie Bilello, US Treasury yields are the highest since 2001, 2000, 2006, 2007. And this is not just a US phenomenon. We can also see, for example, German 10-year yields reaching levels back to 2011 during some of the debt crisis there in Europe. So gosh, this behavior seems awfully strange for supposed risk-free assets, particularly when inflation is supposedly coming down. Why are investors demanding a higher yield to hold bonds when inflation is coming down? Well, it means these things aren't truly risk-free. And so critically, the punchline of all of this is the following. All roads lead to the same outcome. Rates higher for longer? Fine. We go into a recession, into an election year, unemployment rising. There's absolutely no way the Fed will pivot, and the proverbial punch bowl has been brought back to the party. Even if we don't enter a recession, we can see how through fiscal dominance, the debt situation is getting increasingly dire. And again, not just a US problem. We see some truly insane things happening in Japan. They're initiating yet another bond buying program. So no matter how you cut it, we ultimately are going to come to the day where the Fed needs to pivot, interest rates will need to come down, and or it increases its balance sheet once more to inject much needed liquidity, not just for different market participants and to keep the banking system together and all this stuff, but to also keep the US government solvent. So good luck if you're a bondholder, right? You're either going to eat huge losses on your bonds if yields continue to go higher, or you're going to get paid back in inflated dollars. And anyways, as we saw earlier, your yield is not keeping up with the general growth of the economy. Thus, you have a negative real yield anyway. So how long is it before the market starts to see some of these dynamics and allocates into Bitcoin instead? And interestingly enough, and I think it's too early to say whether a single month is obviously confirming or denying this, but this view from Stack Hodler, who puts out some great stuff as well, is very interesting, right? Across the course of September, while a lot of these dynamics were starting to really come into sharper focus for investors, Bitcoin is up. And even though it's been rejected from, 30,000, whatever, it's still up quite significantly relative to its pre-bank term funding program levels from earlier in this year. And we can see how gold, TLT, which is a measure of long-term bonds, the S&P 500, are all down. So Bitcoin's displaying this very interesting divergence that, again, we should caveat because this is only a month's view, but this is something that we should continue to watch. And even though that was a short-term view, it is worth noting that Bitcoin is up nearly 800% or over 800% versus TLT since the COVID March lows of 2020. And I think Bitcoin would be doing a lot worse than it currently is in this environment if the market wasn't already starting to realize the value of having this unconfiscatable, undilutable asset. And so the final view I'll leave you with on this section is that life comes at you fast. I think trying to trade this is an absolutely insane game. You're never going to do it. Historically, this is a view from Ray Dalio. Historically, these reserve currency devaluations happen very abruptly. So trying to time this and trade this, I think, is more than a fool's errand. So you know what we're doing over here, fam. We're continuing to stack those sats wherever possible. So I hope that at least speaks to one of the more interesting scenarios that I've seen people say, well, this is why Bitcoin can't possibly, do well or whatever. But let's now transition to the next broad topic for today and talk through some of the latest updates around Bitcoin tech. So first, Lightning Labs released LND 0.17, which included some pretty awesome features. You have now simple Taproot channels, which allow users to open unannounced channels with Taproot transactions. And again, going back to some of the videos I've done in the past on Taproot in general, that's going to tend to bring more privacy optionality as well as cost efficiency. This is excitingly also laying the foundation for Taproot asset channels. That is to say, things like fungible tokens, riding, these could be stable coins or what have you, riding on Lightning rails. And even if you have absolutely no interest whatsoever in stablecoins, I promise you that is a humongous deal. And so simple Taproot channel lays the foundation that we'll see in the coming months. There's some additional optimization for mobile Lightning nodes through reduced block sync time for Neutrino, which is a Bitcoin Lite client That's actually really cool. And then some improved reliability for watchtowers, which is a service that can protect you from malicious channel closings from peers on the Lightning Network. So pretty cool stuff there. BIP 324 just got folded into what will be the next release of Bitcoin Core. And among other things, this will add what is called opportunistic transport encryption to the P2P protocol that is Bitcoin. And what I mean by that is all the different Bitcoin nodes are passing information to each other. So my Bitcoin node that I'm running here at home or whatever is connected to a set of peers on the network. And so it'll receive information from one of its peers, pass it to another. This is how information propagates on the Bitcoin network. And today, how that information gets propagated is actually not very private at all. It has this fixed string that helps make it easy to identify peer-to-peer node traffic. But that in theory could make it very easy for like an internet service provider to censor peer-to-peer Bitcoin traffic, right? And so BIP 324 is introducing features that will make it harder to do that. It's not going to perfectly solve everything. Again, I just think it's a great example of a change. It doesn't require a soft fork. This is just an improvement to the peer-to-peer node protocol that, again, the average user isn't going to really notice, but that is hardening Bitcoin, and you love to see it. You also had the first Stark-based ZK client for Bitcoin from ZeroSync. So this is pretty interesting. It uses ZK cryptography or zero-knowledge cryptography. I could probably do a whole video on that. It really is interesting, and I think when people are like, well, you know, shitcoins and altcoins are all scams, I do think there is some very interesting technology that has been pioneered more so in these other ecosystems. And zero knowledge is a good example of that is now increasingly coming back to Bitcoin. And so what this does is ideally lowers the barrier to entry to participate as a kind of first-class Bitcoin citizen, i.e. running a node, you know, potentially with a light client. This makes it so that you don't have to download the entire blockchain, but you can still do it in a way in which you're able to verify that you have the correct information that you need as a user. So that's pretty awesome. I do think you will need more light clients, especially if we want to onboard people to be able to use Bitcoin non-custodially, to be able to run their own node, you know, on something like a mobile device. You need a light client to do that. And apparently there's also development of a layer 2 protocol that will sort of go along with this, which would presumably bring a lot of attractive privacy traits. Discussion around covenants continues, right? I did a video way back on BIP 119. Did a video recently on Drive Chain, which some folks will say, well, let's not do Drive Chain, but let's do covenants, which sort of partially overlaps with it. So James O'Byrne has proposed changes for what would still be a soft fork. So again, something that would be very contentious, that would encompass BIP 118, 119, and 345. So we'll have to see how that plays out. And then lastly, Block has released their BitKey beta, which is an open source mobile app and hardware device for merchants to be able to receive Bitcoin payments and take self-custody. So very, very cool stuff. Kind of a smattering of updates for this one. But with all that, let's go ahead and conclude today's video. All right, so we took a look at Bitcoin supply and demand dynamics. We spent quite a lot of time on the demand section because I think it's really interesting what is happening in the macro environment and how that may lead to a broader and broader set of the market and of investors realizing why Bitcoin is so special, particularly in an age of never-ending debt binges from our government overlords. And then we also talked about some of the exciting Bitcoin tech updates. But I'm curious to hear, what are your thoughts? What are your thoughts on any of these topics we've discussed? Are there related topics you'd like to see covered in future videos? Let me know in the comments down below. But I hope you found this valuable and insightful. If you did, you already know what to do. Give this video a like. Use the share feature underneath this video. That really does help get this to a broader audience. And if you are so enamored with this content, you want to donate to a pleb, which really does help me continue to make these videos, you can do so in a number of different ways. If you happen to be using something like GetAlby, the browser extension, you could just click that and it'll automatically detect you are watching my channel. You can also donate sats to my Lightning addresses. And then a quick plug, I do now have a Vita page. Many of you have asked me how you can get in touch with me. I'm obviously active in the comments, but if you have an in-depth question or you have a more custom setup that you want my expertise and insight on, you can reach out to me on Vita. That is the best way to get in touch with me. But we'll go ahead and leave all this here. As a reminder, every sat counts. And until next time, my friends, I'll see you then.